very glad to be here. For those of you who don't know, QuadReal is the real estate arm of the province of British Columbia in Canada, in case you're wondering what a QuadReal is. We have with us Anne Kavanagh, who's the CIO of PATRIZIA, Michael Cochran, who's a Senior Managing Director at Eastdil, and Martina Malone, who's the Managing Director and Head of Global Capital Raising at Prologis. So we're going to talk about trends in capital markets. We all know that capital goes around the world very quickly, looking for optimal places to invest on a risk-adjusted basis. We've heard all sorts of macro issues today in terms of unstable political situations, volatile capital markets, increasing interest rates. I could go on and on and on. But with that as a backdrop, which you've all had, what we're going to try and do is talk a little bit about what's going on right now in the markets and some strategies that we see people employing. So maybe, Mike, you can start us off. And how does real estate stack up against the other asset categories, stocks and bonds? How are we doing in terms of pricing, volatility, availability of investment?
That's an easy question, but thank you, Dennis. It's a pleasure to be here. There's probably a reason why we're the last panel, and that's because we tend to follow the demand drivers throughout the real estate markets. Many times the capital is thinking ahead of where the markets are going, and if you think of we often use the term as we sit down with clients, think not only about the client in front of us, but where their capital's from and what the ultimate CIO is doing within their firm or within their investors in terms of allocating the capital amongst the four major food groups. Obviously, you have investing in underlying government bonds. That was negative last year. Investing in the equity market, somewhat volatile as well. From a U.S. perspective, that was also negative last year. And then if you look at where the corporate bonds markets are, the bond market was actually quite strong. Spreads tightened throughout the year, so that was actually quite positive. But then if you look at the ultimate asset class that is near and dear to us, the real estate markets, although the markets were relatively flat, they still, to a significant extent, outperformed those other asset classes. So the allocation to that sector, actually our sector, including real estate assets, infrastructure and the like, increased through the course of last year, and that's really based upon the effective spread that's generated. If you think about the spreads in the market right now, you're probably getting somewhere in the neighborhood of 300 basis points over the underlying treasury in any given market. That in certain markets throughout Europe, that spread is actually wider, which leads us to believe there's still some room on the upside in that regard. But it's from an allocation perspective, we're effectively seeing real estate still being quite compelling and still getting quite a fair allocation of interest and capital.
Okay, so real estate's in a good spot in terms of an asset category. Let's take a look around the world at how some of the major investors around the world are looking at real estate, either in terms of maybe adjustments they're making in terms of risks they're prepared to take, markets they want to go on, property types. So Martina, why don't you start us off with Asia? We've got Korea, we've got Japan, we've got China, Singapore, and Australia. Give us a little walk through those countries, what investors are doing in terms of looking outside their countries, what they're looking for.
So in terms of 2018 has been an amazing year in terms of indirect real estate capital raising. $120 billion worth of equity has been raised in that year. It was the second largest capital raising year. So there's plenty of dry powder available. If you look at where that capital came from, clearly the US and Europe have been regions that have seen lots of inflows. But what is probably new is the increased allocation from Asian investors, and you said rightly from Singapore, from Korea, from Australia, but most notably, I would say, from Japan. Very lately, there's a number of public pension funds out in Japan that have trillions of assets under management, and they have taken a while to define as to what they want to do, but have awarded mandates now, and they're actually in the process of starting to allocate that capital at the moment. 10 billion or so has been allocated to be invested in real estate. So that's going to make a big difference, I think, to what we do. Where are investors investing across the risk curve? I would say the Europeans, generally speaking, are very keen on core. If they invest outside of their home country, then it's really for diversification reasons. The Asians are the same, core. They also like development, but again, it's for diversification reasons. If you look at the US, they invest in core at home, generally speaking, but when they leave home, they want to move more up the risk curve. I mean, in terms of sectors, I can speak for the logistics sector. Obviously, a lot of capital has flown into the sector. In 2017, about half of the sector-specific allocation went into our sector. We've seen a huge wall of capital come, and obviously that's led to significant cap rate compression, which all of us have benefited from. I would think the outlook is good for the sector, and there's probably more capital to come. So it's been a great year, but dry powder needs to be invested.
So looking at Asia, the Koreans, typically they're yield investors. Is that still the case? I mean, has it moved up or down? Do they really like logistics? Are they prepared to go into maybe some of the other sectors like retail, which are a little bit more challenged now?
So do you want to comment?
No, go ahead. You finish.
Okay. So, I mean, we've seen some Korean capital come our way, and we are mostly raising capital for the core side, so they obviously like that. But I know that they have been investing with others as well on the value add side. But there's a significant amount of capital coming out of that market. But I would think the key driver really from Asia is, from my point of view, is Japan at the moment.
Okay, so they've been talking about the Japanese coming for a while. They're coming now. First is core, or what about mortgage, or what do you guys see?
So the mandates that have been awarded to date are core mandates and value add mandates for the developed economies. So I assume that that's Europe and the US mainly. So those are the mandates, but there might be more coming. And once those larger Japanese pension funds have started deploying the capital, there's a lot of smaller pension funds that are likely to follow. So we keep a close watch on what's happening in Japan.
So the big names are GPIF, Japan Post, anybody else?
There's a number of other names, but yeah, those are the main ones.
Okay, and then what about China? What's going on in China these days?
We haven't attracted any capital from China. We are not marketing in China. We are marketing globally, but have not specifically targeted any Chinese investors, so I wouldn't be able to comment on that.
Yeah. Mike, any views?
Yeah, just your comment are spot on, and particularly in the sector that you're involved in. One word that you use throughout is kind of core. What we're seeing is that core is almost priced to perfection in a lot of markets, and a lot of investors are looking for, let's call it core with personality, or maybe core with attitude in terms of other opportunities. A lot of the capital is looking for yield, particularly coming out of Asia, longer duration, minimum duration lease terms and things of that sort. We agree and that the tsunami of capital that's going to come from Japan is going to be quite significant. They're going slowly, investing through funds and partnerships to have some leadership and sponsorship ahead of them. But the demographics and within the pension systems throughout Asia, Singapore and Korea in particular, is quite massive, and as a result, we're seeing quite a bit of inbounds coming forth. The other dynamic that we're seeing is in terms of from the currency perspective. If you think of the Korean investor market was probably $8 billion of capital coming out per year. A year ago, that was probably 75% in the U.S. Now it's probably 75% in Europe, given where the currency advantages are. And I think that trend will probably continue until things rebalance.
And then for at least in Canada, I don't know, maybe the rest of the world, the Chinese have really pulled back, not seeing any of them, really maybe a little bit CIC, Safeco, but other than that, AmBank's got big sales out. What do you guys see in your markets?
Well, there were four large groups that were, quite ahead of themselves and quite aggressive in terms of some of their acquisitions. Controls were put in place to pull that back, which is effectively alarmed everybody in that market to be much more cautious. I'm not going to get into the geopolitics of Asia, but CIC, One Belt, One Road, is still looking along that supply chain in terms of particularly the logistics sector of being quite active. But that market, compared to the center of attention 24 months ago, it's shifted into some of the other markets other countries that we've talked about in terms of sources of capital.
I think London has benefited last year hugely from flows from Asia, and particularly because of the currency advantage. I think what was surprising is to see that the capital flows in London have held up so well in a year where the UK generally has had quite a tough time with the Brexit discussions, with volumes falling. And, it's extraordinary, really, that in that kind of environment, the London market has continued to do about 18 billion.
That's extraordinary.
Which is more than Manhattan in terms of the market, just give you a sense of scale, which was the reverse.
Brexit's not a problem.
Well, but generally in the market it is. And if you're a European investor, the currency has been a major issue of investing in the UK. Right. And you'll remember that from our previous days. The hedging costs for buying in the UK, if you're buying in sterling, has been really challenging. So many European players have pulled back from investing in the UK, but the flows from Asia have been very, very strong.
Very strong.
Really strong.
What about, then on the continent, the continental players, German capital, where's that going? Anything from the Benelux?
Yeah, I think, look, most, if I look at our European investor base, most meetings we have, most people would like to increase their allocations to real assets if they can and if they can find the right opportunities. Right. I think a really big driving force is cash flow. And of course, a lot of that is about, the type of opportunities that are available, cash on cash returns, really important. And of course, that's become more challenging. So I think, for the right opportunities, yes. I think a lot of activity in the core plus. And then I think on a more international basis, more flows into the value add. And that's what we've been seeing across our business.
Okay. Mike, what about North America, you got guys from the U.S.?
In what regard?
Well, what are they looking for when they're going outside the U.S.? Where are they going? Geographies, property types, risk returns?
Yeah, we haven't seen as much direct capital as I would have anticipated in my 7-year stint here. That a lot of it has come through funds, mostly through private equity funds. You talk about dry powder. There's $300 billion of dry powder. 40% of that is in the top 10 private equity type of names that you would anticipate in terms of dry powder. So that's a lot of U.S. capital that's behind those. And once again, they tend to do core at home, and they tend to go stretch overseas or outside your markets for a bit more yield. And we see that across the markets here as well.
Yeah, and then just to kind of throw on the Canadian side, there's been a lot of Canadian capital that's come out. Some of you may wonder why over the last 10 years. In Canada, the pension funds are aggregates. So like for British Columbia, we're really an aggregator for the entire province. We have over 40 pension funds in the $160 billion fund. If you take the top 25 investors around the world, 7 are from Canada, 6 are from the US. So you kind of wonder how that small country can do it, and it's because they have defined benefit programs, not defined contributions. So they're going to continue. The allocations are high, anywhere from 13 to 18%. So, and people are moving out too. So the Canadian markets are pretty low return. So a lot of capital will continue to come out to non-Canadian markets. So on the private side, we're really seeing a lot of capital. Not a surprise. What about on the public side? At the beginning of last year, public markets and private markets were kind of aligned, but for those of you who've been paying attention to discounts on NAV in the public markets, especially here in the UK, it's a little bit different story now. So Mike, what do you think, what kind of happened in 2018 that caused this dislocation between the private markets and the public markets?
Well, one thing that I would say, and this is just top of my head, just thinking back, in the U.S. markets, there's a much deeper, much larger listed sector, so to speak. And if you think of the office sector has traded at a discount to NAV for the last 5 years, every 60 straight quarters. And you think about the composition of a lot of the holdings in that portfolio, a lot of the holdings are in traditional cities, the big assets, and so forth, some of the bigger names. And there's been a general trend, which we'll talk about in terms of allocation of where, and there was just in the last panel, in terms of urbanization, where technology is disrupting markets, where people want to live, and so forth. And that's clearly the beneficiary has been in the logistics space. The most disrupted sector is the retail space. So 24 months ago, retail internet penetration went to double digits and internet growth went to double digits. And all of a sudden, retail was a bad name in the US. Every company went down. US has since recovered, where there's been a separation between the good and the bad in terms of portfolios. You saw that happen effectively 12 months ago in the retail sector here, which is now the eye of the storm in terms of market correction and panic, in terms of how deep is the tech disruption going to be, how deep is the discount, what's the right pricing, and there's really a bit of a scramble to try to find where pricing is today.
Yeah,
and
I was at the Retail Council with ULI yesterday, and we had quite a discussion about that. And I mean, I think what is interesting is it's all over the place. And, but actually, even in that context, there was still 40 billion of volumes of retail traded last year.
In the private markets.
In the private markets, yeah. And of course, there are some winners and some losers. The valuation side is extremely difficult. And in many ways, one of the discussions in the room yesterday is, has the sentiment been overdone?
Well, I must admit, I kind of went through a few presentations last week. I was in New York seeing some investment banks, and the discounts I was seeing, particularly in Europe and the UK, were stunning. I mean, I've never seen companies with 63% discounts to NAV, as we see with Intu right now. So I guess it's either a problem with the public markets, the private markets, or the valuers. Any views?
I think there's a little bit of a disconnect in terms of a mark-to-market or flexibility. The capital is trying to find, trying to move, as you said before. The capital is very global, and I think the markets are much more efficient than they were, where if there's a demand driver, a sector that's out of favor, the capital is going to flee. But the structure of the listed sector currently is takeover code here. In the US, you saw a lot of privatizations that came through that cycle. You saw some of that in Nordics, some in Spain, but UK has got a somewhat unique structure in terms of, and I would envision there'll be some disruption or some catalyst to compress that gap.
Yeah, I don't think 63% is sustainable, right?
Yeah.
Exactly.
Okay, but it does seem like if you're a listed company and you're trading at anywhere even close to those discounts, one, your loan to values skyrocket up, so you don't have access to the debt markets, and you're certainly not going to issue equity. So in terms of sources of capital, it doesn't seem like the public markets are really going to be that active, but we'll see what happens. Maybe more a source of product. Kind of looking at capital and how it impacts supply. And let's move over to the debt side now. How's it going on the construction financing side? When developers get money, they build.
Yeah.
Are they getting money now? How's it in the banking market for construction?
You absolutely can get construction finance. It is available. But I think for the right scheme, in the right location, with the right sponsor, and a well thought through plan. But it's absolutely available. One of the challenges in development at the moment is the capacity in the system, and particularly in Germany. Really, really challenging if you're looking at, and particularly if you're looking at what I call medium-sized refurb projects.
Right.
It can be extremely challenging to find, well, certainly when you're doing your underwriting, to price in the construction costs, and also to find a general contractor. So, you need really deep skills in-house to be able to manage and navigate your way through that. And I think we're seeing that right across Europe. I think, particularly in Germany, but right across Europe, and we're seeing generally construction costs increasing.
Yeah.
But financing is available, and certainly the projects we've got, the financing hasn't been an issue.
Any concern there's too much, or does it feel about right? Or
Generally, and I mean, sweeping generalization, but I think that, we've not seen a huge amount of supply in most markets and across the sectors. And we're seeing masses of structural change in the markets. So the demand side is for something different that often isn't being provided. And therefore, I think there's still an opportunity if you can provide the right kind of concept in the right location. And, on the back of the trends we've seen today, urbanization, companies wanting to be in the center of the CBDs. And, if you can find the right sites, if you look across the markets, particularly across the key markets in Germany, in Paris and in London, the take-up on the occupier side has been really strong. Really strong.
One thing you mentioned, just to point out, in terms of construction cost, we do tons of development, especially in Canada, but everywhere, particularly on the western coast of North America. We're getting 10 to 15% cost overruns on our budgets based primarily just on labor and steel.
Yeah.
And it's I don't know if you guys have been experiencing that too, but it's, in this low inflationary environment, it's interesting how much inflation and what a hard time we're having on maintaining costs.
Yeah. I think we're seeing the same in Europe, and in many ways, I would say it's probably, construction costs have probably increased 20%.
Wow.
In some of the markets. And you have to factor that in if you're buying.
So Mike, let's stick on debt for a while. So it sounds like on the construction side, capital, maybe not too much, it's kind of okay. Just generally in debt, we've had a bit of a change in the debt markets with all the regulation after the GFC. We've had non-bank regulated lenders. Kind of, how does it feel? I mean, Eastdil raises a lot of debt capital. How are you kind of seeing the capital available for that, and maybe how some of the non-regulated banks are playing?
Well, I think that
regulated lenders, I'm sorry.
Yeah, but the markets here have shifted dramatically over the last half a dozen years. That originally there was country lenders, there was a dozen lenders perhaps to do anything of volume. So you went to your local lender and took what their terms were, and a lot of them overlent and through the financial crisis. So there's a period of time of working through those portfolios, and then since then there's been a proliferation of international banks getting comfortable coming here, as well as the non-bank debt funds, which have been booming in terms of their growth. And the market has almost become so efficient that if you want a development loan, you go to XYZ. If you want a retail asset deal, or you want a logistics, you can almost, as my senior advisor Marcus says, horses for courses. You can be very efficient out of the menu of 150 lenders. So we're just playing matchmaker in many regards in terms of finding the most efficient and lowest cost of capital. But the regulations have been a speed bump, but haven't necessarily discouraged the amount of lending activity that we've seen.
What about the CMBS market? How's that doing these days?
CMBS States was probably at its peak 250 billion. It's probably 60 to 70 run rate. It went to 100, but it's kind of stabilized there. And the challenge is that you need more skin in the game, and it doesn't have the hyper derivative market which caused the financial crisis in existence anymore. The market here was at its peak like 60 during the financial crisis. It's now, last year was 4. 4 is up probably 400% from where it was 2 years ago. So it's
not a factor.
It's really not a factor in terms of where the lending volumes are. But for the right profile, it's people are still looking at it as an alternative.
And then what about the mezz markets?
Mezz are very strong. Mezz are, you can get mezz now at 5 to 6%. The markets back when there was only 12 lenders, there was a lot of U.S. opportunistic capital that came over here offering 12 to 14%, but there was no senior market, no first mortgage market. Now that's kind of flipped around. And so the mezz market's quite strong, and a lot of the names with all the dry powder have developed lending platforms or groups that are coming into the market to try to find a little bit more yield from what they can invest on a direct basis in a lower part of the risk curve.
That's interesting. I actually, last week, I was in Washington at the Real Estate Roundtable and moderated a capital markets panel for their annual meeting, too. So one of the things that we had the CEO of PNC Bank, which is like the number 3 lender in the U.S., and the CEO of the Blackstone funds. And they actually kind of agreed that the way they're dividing up the world is actually pretty healthy, frankly. If there are foreclosures, firms like Blackstone are much more capable to kind of deal with these issues than the banks. And the banks have gotten much more conservative given the capital charges for construction loans, land loans, and everything like that. It was interesting to hear Jeff Staley today saying that he thought that the health of the banking system was actually pretty good. Pretty much what was the conclusion from that panel as well. Maybe we should turn now a little bit to maybe the market, property market dynamics. And Martina, logistics has been like the best sector for the longest time. Do trees grow to the sky? Will this just keep going? I mean, even at QuadReal, it's our highest conviction. 20% of our portfolio is in logistics. How long is this going to keep going?
Yeah, so listen, I mean, I'm responsible for capital raising at Prologis, so my job definitely has become easier. I shouldn't tell my boss that. But in any case, I mean, the fundamentals for logistics in 2018 have been phenomenal in terms of if you look at the demand, obviously demand is very much driven by secular drivers of demand. We talked about e-commerce, we talked about urbanization. Those play a big role as well as supply chain reconfiguration. And if you look at the economy over the last 10 years, that grew by 10%. Here in Europe, the logistics sector grew by 70%, and the reason for that is really the structural drivers of demand that are really supporting that, or continue to support that growth. So from that point of view, I don't see that really changing because e-commerce is just in its infancy, and we expect that e-commerce is probably going to double over the next 5 years. We are all consuming.
And when you say double, here in Europe or where?
Yes, here in Europe, but I think that's a global trend, generally speaking. And also supply is in check, right? If you think about the supply that's coming online, I mean, 60% or so is built to suits. About 40% is spec, and the spec we really only see in markets where there's very, very little vacancy. And so from that point of view, occupancies are high, our warehouses are basically full, customer sentiment is positive. Cap rates have come down dramatically. We believe that they are going to probably stabilize somewhere, but we see rental growth. And so if someone invests in the logistics sector today, really the main driver of return is going to come from rent growth that we have seen in the States for many, many years, double-digit rent growth. And in Europe, in 2018, we've seen 5%. How long will that last? Obviously, we don't see any slowdown at the moment, so this is all what we know. But what we think might happen is that some of our customers might push the pause button at some point, given the volatility in the market, and delay some decisions. And so that might have an impact on the real estate market overall, and obviously also on the logistics market. But generally speaking, I'm very positive about what's there to come for the logistics.
And in Asia?
In Asia, similarly, I mean, the market is, generally speaking, there is just a lot of demand, especially driven by e-commerce. If you look at China, for example, the Chinese consumers, 3 times as many internet users as in the US. They do everything over their mobile phone, right? So that's obviously a specific case, but there is a case. I mean, we are in Japan and we are in China. All of our warehouses are basically pretty much.
So do you see more triple-deckers coming to Europe?
Yeah, I thought that I get that question. So in Japan and China, we've been developing multi-story and multi-level for many, many years. So I think 90% of our Japan portfolio is actually multi-story, and in China it's probably 30%. It will come in Europe, and where I see it will come is in cities like London or Paris, where you have big populations, you have a high affluence, and you have a lot of density, and you have land prices that benefit multi-story construction. Obviously, the issue in London, I see the planning is changing. It's all about better use of space, more density, and so on and so forth. So I would see that coming, probably in Heathrow, probably in Park Royal, maybe some other places close to central London. The issue is obviously you need to get the rent, right? Because and that's less of an issue now because our customers, generally speaking, want to be in the right locations, very close to the end consumers, because for them it's really about service levels. So they want to deliver same day, same within an hour, within 2 hours. And in order to be able to do that, you need to be very, very close to where the consumers are.
Okay, I guess a follow-up. I'm just curious from your perspective as the largest player in the space, and the trend of urbanization and the trend of last mile, that speed or that instantaneous, I click on it, I want it that afternoon. How do you think about vertical integration into the urban environment or last mile? Is that part of the strategy, or
yes,
in addition to double, triple stacking, but it's a little bit more granular, but it's as if the trend is coming, you need to be in.
Yeah, so we don't call it last mile, we call it last touch, because it might be a little bit more than a mile. But probably 30% of our portfolio is what I would consider last touch, to be delivered to the end customer within a very short space of time. There's very interesting concepts, obviously, and nobody's really figured that out, what that exactly means. But we are, for example, looking at, call it parking garages, right?
Sure.
Where you could reconvert a parking garage, and then you have electric scooters or bicycles delivering to the end consumer. We're looking at retail space
Right.
Yeah.
to redefine an office, for example, right?
And I think one of the things we like about that sector is even in the core logistics space, we've generally been buying below replacement cost. When we're seeing land values increasing, we're seeing rents increasing. So when you look at the underlying metrics, it looks pretty comfortable.
Right.
And the interesting thing is, if you talk to our customers, so the entire supply chain cost, so what does it cost to get a product from where it's being produced to where it's being consumed, only 5% of that is rent. So by being closer in, you save on transportation costs, which is 50% of the cost. Labor is 30% of the cost. You want to be close to where your labor pool is. So we are actually having discussions with our customers that go way beyond the rent, because we are actually saving them money by putting them in the right location, even by charging higher rents.
It's interesting. We did the exact same study for Toronto and came out with 4%. Same thing. That's unbelievable. That's very interesting. We were bidding on some Amazon facilities. In fact, we have one in Vancouver. It's really expensive land there. There are 3 stories, but it's all racking inside. There's no floors. And they've got little, bots that kind of go up and pick things out. We've been kind of wondering what the residual value is of those things after the 15-year lease. What do you think? Are taller buildings like that without the floor plates, just, with racking, is that the future, or are we going to have a problem on our residual values if they don't renew?
That's beyond my pay grade. I'm on the capital raising side, so I wouldn't be able to comment on that. All I'm saying is that this is something that is likely going to be coming in places like London, like Paris. We see it in San Francisco. We see it in Seattle, and obviously it's been around in Asia for a long time. But again, these buildings are not cheap to build.
Drones, is that a ways off?
There's potential around drones, I would think. But the issue about drones is they can only really carry one package at a time, and then they have to come back and be recharged. A delivery truck can store many or deliver many packages in one go. Rather than drones, drones will have will be deployed in some cases. Look at the Australian outback, for example, where you don't have that population density. Can we see drones flying over London? You remember what happened over Christmas at Heathrow and at Gatwick. There's a huge security issue around there. There's regulation that we need to tackle and so on and so forth. I think what we will see much quicker than drones for delivery is what I said, the bicycle deliveries, the e-scooter deliveries. Maybe a guy with a rucksack running hopping on the tube and delivering something, or delivery vans where you have a little robot coming out at the back and delivering goods. So I would see that before I would see drones delivering to a specific home, at least in highly densely populated areas like London or Paris.
Okay, so let's flip over to the next most favorite property type, PRS, multifamily, and everybody talks about it, as you and I know from our days at Oxa. We talked about it for 5 or 6 years. How's it going? Are people actually building these things now? Is there a lot of opportunity? What do the returns look like?
It varies from market to market. I mean, in Germany, it's a huge market, and in many countries on the continent, in Holland too, on the continent, it's super deep. We manage 10 billion of residential, and produces great income. It's really granular, and I think it's a terrific sector. We've just launched a core fund in that space, along with others. I think there's more and more institutional demand to invest in the whole living space, not just micro apartments, hospitality, student accommodation, which you've been very active in. I think the whole alternative space of beds and living is very, very popular. And as we've talked about at this conference and other conferences, the issue of affordability, about housing provision, a lot of people moving in and talent moving into CBDs, and then the issue of housing. One of the things we're seeing certainly in Germany is that, if you look at sites and the underlying appraisal value, the conflict between kind of commercial use and residential, and of course the authorities want to see more residential, which again is making some of the cities very, very squeezed on providing commercial space. Most of the cities that are growing need more residential. So, we see tremendous opportunity in that sector. I'm sure the pricing's tight, a lot of forward fundings in the market. It sometimes can be hard to get really great quality that's already income producing. So, that does bring some challenges. But we've been very, very active in that sector.
So what kind of yields on cost can you develop to, just to kind of get a sense? What's the range on that?
It depends on the quality of the portfolios. I guess we're trading out of portfolios now that we bought 3 or 4 years ago that we've had spectacular returns from. I think that, you can, if you're buying core and you do some privatizations, you can do an IRR between 6 and 7, without use of leverage too much. It varies from market to market. But I think the UK is the market that a lot of players have looked at and, would like to see more PRS. It's still quite challenging, and it's still a relatively small segment. I think I read stats, 3 billion in that market out of a 70, 80 billion market. It's still relatively small in the UK in comparison to other European markets.
With kind of the softening in some of the housing prices, I've been hearing some of the resi development companies are kind of flipping over from sales to rentals. Does that happen, or is that just talk?
I think there's quite a lot of that talk in the UK. The challenge for that we've always seen is that, to be successful in that sector, you need to build for rental because you need the right specification for your maintenance costs over a 30-year program. And fundamentally, many of the UK house builders that are building to sell aren't building for a 30-year maintenance program.
Okay.
And so I think
product.
It's a different product, and I think there'll be some challenges there. And I think quite a few entrants have maybe moved into that market thinking it's a way to solve the supply issues, but I think there will be challenges.
Okay, let's move to the second least favorite sector, Mike, offices. As you said, they've been trading poorly. What do you think? You can talk about it in Europe, North America.
Look, I don't necessarily think they've been trading poorly. My comment was on the
But talking more about the public markets.
The public market, but we've experienced, to Anne's comment in terms of the trading activity here in London, still continue trading very strong up through probably the vote that didn't go through, and now the markets are somewhat frozen in terms of, and no investor wants to put their neck out through investment committee and commit to it. But in London, the pricing from, say, 24 months ago, best trophy long-term leases, and you know the iconic buildings and the recent ones that traded this year, pricing was probably 10% different, same credit, so to speak. The rest of the market is probably a deeper discount, and if you look at where the listed sector is, it's probably a barometer that there's going to be some correction in terms of where growth is and so on. On the continent, though, particularly Germany and France are almost priced to perfection. It's hard to see. The cost of financing there is so compelling. Stuff is trading at 3.5% to 4%. Some even through that. It's, the comment of where cap rate's going. It's hard to think there's much additional room. I think there's more room in terms of the growth, in terms of rents, because a lot of these markets are undersupplied. I think Frankfurt's had a very busy. It's interesting. That market's had a lot of trading activity. It also has a lot of development coming online, and now they're starting to build high-rise resi, which the market needs. Be interested to see. There's a lot of talk about it being the beneficiary of Brexit. I don't think that's necessarily the trend of why it's having so much activity. Paris, in particular, is also very strong. A lot of groups are looking for yield in beyond that triangle. To go south, go east, go north. For a little bit more yield in the office sector. The other thing that we're seeing, obviously, in the office sector is that there's some new clusters that have been assembled in certain cities, like King's Cross or like a Hudson Yards, where the center of gravity is moving. And the biggest occupier, the biggest demand driver has been WeWorks, or the co-working space. And one of the things that we're seeing there is similar to the disruption of technology and so on. Everybody wants flexibility. They want to shorten their commitment, and they wanted the latitude to move about. And so it's going to be interesting to see how those, we could talk through that, but how those sectors impact long-term the demand for office and the profile of office and the tenants and who actually controls the buildings.
Just on the co-working, is there a percentage in your building of co-working that impacts your cap rate or your pricing?
Yes.
What's the break-even?
Very scientific. No, not quite, but...
I'll tell you what I've heard. You can tell me what you've heard. Go ahead.
Well, we've actually tracked this for the last 3 years fairly closely, and in terms of the trends, and because the model has evolved from where it was. It used to be that if you had them in for, say, 5 or 10%, that was a real anchor in terms of getting the millennials in your space, getting the buzz going, an incubator for growth for future tenants and so on. But if you had them more than 50% or a higher percentage, oh my gosh, where's the credit? What's the sustainability? What's their absorption? And that was 50 to 75 basis point discount. As their model has evolved, where now it's a lot of their subtenants are more institutional clients, bigger occupiers that using that as their expansion space, that gap is narrowed to almost par in terms of where they're at. And they're going to disintermediate, I think, a lot of landlords, a lot of agents that make a lot in terms of leasing that space. They're going into the asset management game for these buildings. And if you own office buildings yourselves, you might dismiss them and say, I don't want them in my space. But I would advocate putting them in and learning from them to apply it to the rest of your portfolio, because it's kind of the wave of the future in terms of how things are being managed.
And much of the flexible office space on the continent?
There is, and it's growing, but not to the same extent as London. Yeah. I mean, in London, it's a huge part of the market. I guess one of the things I was going to say is, I mean, we've seen tremendous rental growth in some of the sub-markets in places like Berlin, in Barcelona, on the back of some of the occupiers that are really growing rapidly, and where there's a huge shortage of space, where there hasn't been a lot of new space provided. I mean, we've got half a dozen projects in Berlin, and we've seen tremendous rental growth since we bought into the buildings. And the same in Barcelona. And, I think that, some of the occupier markets in Europe have only really been recovering in the last 12 months. So, we talk about being late in the cycle in some places. Actually, it's only just started to happen. And it's easy to forget that.
Okay, so no oversupply in logistics, no oversupply in PRS multifamily. Sounds okay in office-ish in terms of oversupply.
Well, I think there's probably some shifting supply of older stock that needs to be repositioned.
Okay.
So that's where the oversupply is. There doesn't seem to be excess development creating supply.
Got it. And then retail, we'll just leave that alone. Nobody can figure it out. Okay, so now let me ask the panel, what do you think of our audience's judgment here? Cap rate expansion and unstable politics. Not worried about interest rates. That's pretty, and urbanization not a factor. What do you think, Anne?
I'm not at all surprised. I mean, you look at the discussion we had this morning, and, we've been living and dealing with Brexit, living and dealing with yellow vests in Paris, living and dealing with, Italian politics. In Europe, it's hard to, open any newsreel without there being something about politics. So I'm not surprised that people are concerned about that. And I think particularly until we know which way the Brexit outcome is going, I think there will be concern about that. And cap rate expansion, I think many of us have been anticipating that for some time. And I think that's why we're seeing more caution in the markets. And I think, that's partly what's playing out in the listed sector. It's this anticipation of change coming and what's going to trigger it. And I think, that's been taken into account really probably for the last 12 months. And, people wondering if there'd be some kind of shock, and would that, we asked this morning, I think, to somebody about the, what are the unknowns? And of course he said, well, there's plenty of knowns out there. The only thing I would say, when, we were in a discussion with a group of us in our office last week, and actually, some of our research team put it in context and said, what, at any time over the last 25 years in Europe, there's always been big things out there.
Yeah,
and it
right.
is, and the summary was, is populism that doesn't have a majority, is that worse than Saddam Hussein or some of the other topics we've been dealing with? And if you look back, actually, there's always something big out there. And I think some of it is. We thought the
euro was going to blow up.
Yeah, exactly. And, we used to have weekly calls on what would happen if the euro blew up. That was much more challenging than what we're dealing with today.
Mike, Martina, any views?
Yeah, I think unstable politics, as I said before, I wouldn't be surprised if that had an impact on the real estate market, obviously, and on the logistics market. The way we're trying to protect against that is to have the best real estate in what we believe are the markets that matter most for logistics real estate. Those markets will recover quickest, and that's where we see the highest rental growth. So over the past 5, 6, 7 years, we've probably sold $14 billion worth of logistics assets out of non-strategic markets, and we've reinvested that capital in what we believe are the best markets for logistics real estate. So we really have built a very core portfolio. We've got an A-rated balance sheet. We have brought our leverage down. So we've done a lot of things over the last number of years to get our house really in order and to be very well positioned for if and when this is going to come. Yeah. We don't see any signs in the sector, as I said before, but as and when it happens, I think we're probably well positioned.
Actually, one thing I didn't say on the multifamily is that I think that politics, one of the concerns in the multifamily sector is more inequality. And of course, if politics becomes more unstable, the authorities will be under more and more pressure to bring in regulation.
Rent control?
Rent controls or provision in the master planning for affordable housing. And so, that's one of the concerns or one of the risks in the multifamily sector, is seeing changes that would be brought in on a regulatory basis that you're either not anticipating or that come as a surprise. And that's something we're tracking pretty closely.
Okay, well, definitely people don't want to invest in less established markets. Okay, so much for Greece, guys, sorry. What do you guys think? What would you do? What are you doing?
Well, I would say we're doing some of one and some of three. I think one of the challenges with three is that if you look back traditionally, a lot of people in the past would have had 40% in offices, 40% in retail, and 20% in industrial or logistics. One of the challenges we've got is that the alternative sectors are still relatively small.
Yeah.
And for the weight of capital, the entire European market, direct market, is 300 billion. That's small too. And then when you really take out the other non-traditional properties, they're relatively tiny in the context. And what you can't do is downweight your office portfolio or retail portfolio and significantly invest in others. Certainly what we're being very cautious about is investing in the less established markets. I think all of the learnings from the last cycle are if markets get tough, the liquidity dries up pretty quickly, financing dries up pretty quickly. And I think that one of the things we're seeing in the market at the moment is not always enough differentiation between, you could be better taking, 20 bips, less return, but staying in the core markets. I think that that's one of the challenges. We've seen the volumes of activity in all of the markets increase in 2018, and the pricing reflecting that, and not much differentiation depending on which market you're in.
Okay, well, we certainly saw that. You guys, any?
My comment would be there's no free lunch anymore. It used to be the prior slide, cap rate compression. A lot of people did pretty well doing that. Most of our conversations today with clients is on number three. People are looking at alternatives. What's challenging is that investing in real estate is really hard. And getting comfortable with the non-traditional classes of real estate, we've really beefed up our intelligence and expertise in that area so that we can talk with clients about what the returns are, rewards are, how to invest there. In terms of number one, clearly sticking to your knitting where you have a competitive edge and you think you can outperform within your portfolio or within your expertise, you're probably going to make the most money there. You're going to make shorter term money perhaps in number three in terms of some of the diversity because you want to perhaps diversify out of some of the traditional asset classes we've already talked about which have significant stickiness or risk associated with them, be it retail in particular or office. So we're seeing a lot of our clients, investors, gravitating towards number three because they're cautious about taking on more speculative development.
Okay, so I'm going to ask you guys all for closing comments on kind of what you think, advice you want to give everybody going into 19. But before I do that, while you're thinking, the conclusions of the panel we had in Washington last week were, one, everybody really remembers the GFC. It's kind of interesting. That was an event that was seared in everybody's brains, so people are nervous. Tons of equity and debt. But the thought about that, though, was we're all waiting for this price correction with a recession, but if you've got $300 billion of equity sitting on the sidelines waiting for a price correction, how much of a price correction are you going to get? So despite this, the feeling was that there's some discipline, probably because of point one. Everybody's still afraid or still nervous from the GFC. Everything's expensive, like here. Most people feel there'll be a recession pretty soon, 2020, but felt it would be shallow. And everybody's kind of staying in the game, but they're being very careful. So what thoughts, comments, what you're going to do, would you offer the audience as we close our session?
I mean, maybe just from a capital raising point of view, I mean, we discussed that there's a lot of capital coming into the logistics sector. So the capital raising side of things is not the issue. It's deploying accretively within a sensible time frame. And so what we are doing with investors is, because we're building up queues on our funds, we're not investing the capital just because we have it. We're only investing it accretively as and when the right opportunities arise. And managing those expectations in a market like this, I think, is very critically important. And investors get that.
Yeah, thank you.
Well, at the capital market session on Monday, there was also a vote of, will you invest more, less, or the same? And we're having that discussion with all of our clients. We're in the service business trying to give them advice. And we think this is a year in transition where groups are trying to determine the winners or losers, what sectors to be in, and navigating through that. So I would encourage everybody to invest in your people and your expertise, to have some foresight and thought leadership about where to navigate in that. I'm not going to sit here and try to pontificate on where I think that is. You have to come and talk to us in our office to do that. But
Pay a fee.
but in all seriousness, investing in your people is even more important, and strengthening your skill sets to navigate through these more challenging times is really important.
For those of you who went to the breakfast session, I actually wrote Wolfgang's quote down, where he said he stopped investing in real estate and started investing in people.
Absolutely.
I love that quote.
That resonated with me. I wrote that down as well. I didn't write the horse comment down, but I did write that one down.
Okay, Anne, are you going to follow Wolfgang and have some illustrious quote about horses? Or
No. But look, I think that sticking with your expertise, I think, is really key. And we've got people on the ground in 21 markets in Europe, and I think Mike said earlier that the risks are on the downsides. You've really got to, but you're not going to get bailed out. So you've got to get it right, and so therefore I think you need discipline. On the other hand, but I think periods of change, and we're seeing massive structural change across all the sectors, always brings huge opportunity if you really understand the markets, you understand what some of the future potential and concepts can look like, how you might price those, and also, looking at the kind of land value and some of the emerging trends. And, that's really what we've been doing for the last few years, and we'll continue to do it. And, it's similar to the strategies that you're deploying around the world. And I think the other thing where we're also heavily focused is looking at services to customers. And, I think that's been a big theme of today. We're seeing a lot of disruption, but a really big focus on how you're responding to that and what services are you offering to, and in our case, I would say to, our customers on the portfolio and also our investors. And that's through innovation and tech. And so, that's also, for 2019 and 20, that will also be a continuing theme.
Okay, with that, we'll wrap it up. Thank you all very much. Thank you.